Good afternoon, my fellow traders. My name is Michalis and I'm one of the market analysts here at HF Markets, and I'd like to welcome everybody to another webinar. Now, this is a very important webinar. It's probably the best webinar a beginner trader can watch. How to develop your very own first trading plan. And to be honest, we do a lot of webinars, and some of the webinars we look at what kind of mistakes beginners, traders in general, new traders do. And most people say that the biggest mistake that I've done, or that I've seen traders do, or that traders in general do, is to start without a trading plan. So this is what we're going to be looking at as part of today's webinar. I can already see some questions. I've got a lot of people saying hello, welcome back, etc. It's great to see everybody. It's great to see everybody. Hopefully you find today's session educational. Before we get started, just a very quick introduction so everybody knows how today's webinar is going to work. The webinar is going to be split up into 3 sections. We're going to do a very quick introduction. We're of course going to tell people, things like what's included in a trading plan, why a trading plan is important. Then we're going to go and start looking at how to create your very own trading plan, and a very simple way of doing so. And then we'll continue to look at trading plan examples, and then we'll actually go onto the MT5 and look at this together, going through it step by step on how to create a trading plan. Now, like I said, before we start to look at those more in-depth pieces of information, very quickly, I want everybody to be aware that this webinar is here for educational purposes only. So we're not saying to anybody that this is what you should be buying, this is how you should be investing. We're not giving independent advice, financial advice, investment advice, but what we do want to do is give you the right educational information, as much educational material as possible, in order for you to be able to trade securely, safely, responsibly, and with full knowledge and confidence. That is, of course, what I want to be able to achieve as part of these webinars. And I do think this is very important. A bit about myself. I've been in the financial service market for 10 years. I've been trading for many, many years. I'm not even sure exactly how many years I've been trading. It's been so long. I am a licensed financial advisor. I am licensed in the UK. I hold the CMAP license, and I'm also licensed in the EU as well. If you go on CySEC's website, so that's the regulator's website, you can see that I am on the list of certified individuals. So this is what I really wanted to say in regards to myself, because what I want to do is put all of my knowledge in regards to trading plans, put it into one presentation, a 1-hour-long webinar, and put it in a way which is extremely simple. So I want everybody on every single slide that they see for it to be something that they can use instantly, something that you can learn and start to use today. We've got a lot of people that aren't economists, they're not mathematicians, they're not financial advisors. So I want to show everybody how to create their very first trading plan, even though you've never traded before, and to be able to do it in a simple, stress-free way. So the first thing I want to look at is, why is trading a trading plan so important? Now, the first thing I want people to understand is, if you're new to the financial trading markets, you will make mistakes. You will have certain trades that you're going to close in a profit, and some trades that you're going to close in a loss. It's not an issue. The way that we should think about trading is like a business. Every single business has turnover, they have sales. So basically they're selling something, whether it's a product or services, that brings money in. And they also have expenses. Every single company has expenses. And that's the way that we need to start looking at trading. This is why when we open a business, we have a business plan. And when we start trading, we need a trading plan. Now, like I said, you will have losing trades. You are new to the market, you will make mistakes, and you may make a lot of mistakes. To be honest with you, you are going to make a lot of mistakes, and most likely you just like everybody else will make more mistakes than good decisions. So why would you start trading? Even though you are making a lot of mistakes, even though you may have more losing trades than profitable trades, this is why it's important to have a trading plan. Because regardless of whether you're an experienced trader, inexperienced, a successful trader, or even if you're unsuccessfully able to determine how the market is going to move, you still need to be able to be profitable. So even if you're new, completely new, let's say, look at me for an example. I've been in the financial service market for 10 years. I've got a lot of experience. I've got a high success rate, and I can be profitable. Fair enough. That's scenario number one. Scenario number two, somebody else, like some of these individuals watching today's webinar, have never traded. They know nothing about trading, and they're going to make a lot of mistakes, and they will have a low success rate. But that doesn't mean they still cannot be profitable. And this is why a trading plan is extremely important. Even though you are new to the market, even though your success rate may be only 30%, what does that mean? That means if you're opening 20 trades this week, that means you're only going to see 6 trades in a profit and 40 trades in a loss. But you still want to be profitable, even though you are on that learning curve, even though that you have a low success rate. And that is why it's important to be able to build and develop your first trading plan in a way which will ensure responsible trading, controlled trading, and the ability to make profits, even though you've got a low success rate, even though you're on a learning curve, even though you've never traded before. That is something extremely important. This is the biggest mistake new traders make. So let's go through all the points. When you've got a trading plan, traders can identify how to improve. Traders can identify what mistakes were made. But if you don't have a trading plan, you are unable to do so because you are trading. You haven't got a trading plan. You're testing different assets. You're testing different methodologies. You're using different strategies. You may not be using anything at all, but you're trying to trade. And then when you come to the end of the week and you're reviewing your trades, there is no logic behind it. There is no logic. The only logic and method that you are using is to not be having a logic. So how can you improve as a trader? Because you've been traded for the first week, you're definitely going to need improvement. But how do you improve? I speak to so many traders after the first week of trading. After the first week of trading, they found some difficulties. They start to realize, okay, I need education. I want an educational session one-on-one with Michalis. And I speak to them, and he says, I don't know how to improve. I've been trading a week. I've been trying to trade and follow the trend, but I don't know how to improve. And I know straight away he doesn't know how to improve because he doesn't have a trading plan and there's no logic behind his trading. It's like, for example, if you're a business consultant, and I've been a business consultant before in the 10 years in the financial service market, where we go to a company and the company says to me, I need to improve. And we say to them, okay, I want to see your financial accounts. I want to know the product. I want to know the budgeting, where the budget is being spent, how much is being spent on marketing, what's the cost per acquisition, etc., etc., etc. And I look at a lot of these things and I see, how can we improve as a business? If I go to a business and try and improve it, and he can't give me anything, he can't tell me what the budget is, he cannot tell me what his business plan is, he doesn't have accounts, he doesn't know what the cost per acquisition is, and so on, I can't help him. I cannot help him. He cannot help himself either. So this is why trading plan is extremely, extremely important. This is one of the reasons. So another thing, we're going to move on to point number 2. Traders struggling with emotions tend to be the individuals trading without a trading plan. If you've got a trading plan, regardless of the fact whether the market is going to plan or whether it's not, because if you've got a trading plan, you're prepared for either way, it's okay. You're okay with it. So, for example, I spoke to somebody, I think it was on Monday, and we looked at his trading plan. We developed it, not together, of course. I showed him how he can develop a plan, and he developed it in front of me. And he said to me, you know what, now that I've created a trading plan, I'm not stressed because I know if this happens, this is going to be the end result. But if that doesn't happen, it doesn't matter because I know the end result is not A, but it's going to be B. I'm not going to give too much information about that because we're going to look at it on a different slide. But hopefully you get an understanding. If you're trading with a trading plan, you will not struggle with emotions. And to be honest, most mistakes tend to come with emotional trading. That's something also very important. Most mistakes tend to come with emotional trading. So you need to be cautious about that. Less mistakes are made when you're following a trading plan. Point number 4, beginners can adjust the trading plan and test new adjustments on the demo account. Whereas if you're trading without a trading plan, how do you know what you need to test? For example, I remember quite a long time ago, again during a one-on-one session, the trader said to me, I've been trading for a month, I haven't been successful, and I'm thinking of testing this thing. Okay, he was trading without a trading plan. He said, I'm thinking of testing this strategy. And I said to him, okay, let's look at those trades that you've been opening. And I said to him, you're looking to test it, but I can see on this trade, you were doing the same thing. And also on this trade, you did the same thing again. Now you're trading without a trading plan. Some of the trades used, even without you noticing it, you use this strategy. On some trades, you use a different strategy. So you're trying to test something without knowing you've already tested it. So you know if you've got a trading plan and you're testing this strategy, you know, okay, based on that strategy, I have a 50% success rate. Then if you want to test something else for the next 2 weeks, you've got a trading plan, you base it around that strategy, and you're strictly following only that strategy for 2 weeks. And then you can compare the two. This strategy has 50% success rate. The second strategy has 60% success rate. And then you're able to make informed decisions as an investor. So that's something, again, which is extremely important. This, guys, is kind of like an introduction. We're going to look at this in more details. I just want people to understand the aim of a trading plan and why it's so important, and to get everybody into the right mindset. What you don't want to be doing is trading, you know, in the UK, we say we're trading on the flu. So yes, we want to be trading without emotions, but you don't want, and yes, we want casual trading, but you don't want it to be lucky. We're not gambling, we're not betting, we're not trading irresponsibly. Everything is controlled, it's beautiful, it is exactly to plan. Now, somebody may say you cannot trade to plan because you don't know what's going to happen within the market. It doesn't matter. It doesn't matter whether the first thing is going to happen or the second thing is going to happen. Your plan is 100% prepared and 100% controlled. Avoid mistakes which are endangering your overall trading. This is also why it's important to have a trading plan. I can see a lot of questions. Guys, as always, with our webinars, I like to see a lot of questions. If you don't know something, ask me. If it's related to the webinar, great. If it's not related to the webinar, again, ask me. We'll look at it. Even if it's at the end of the webinar, I'll come back and I'll look at it. Yes, it's a webinar. Yes, it's a presentation, but I want it to be like a conversation. So I can see there's 3 questions. So somebody says, I'm of course not going to expose male, female names, etc. So she says, or he says, not that new, but a lot of mistakes initially, largely due to a lack of emotions, lightness, and ease. Didn't stick to the plan. So this is what we're going to look at today. Maybe it's the fact that the plan wasn't set out how it should be set out. So this is what we're going to look at today. Wait, you need the trading plan for each asset? Not necessarily. You don't necessarily need a trading plan for each asset. So the basics of a trading plan. So what are we going to look at as part of a trading plan? And I want people to enjoy trading. I want it to be casual, but I want people to stick to the trading plan. Otherwise, the trading plans are not going to work. And if you don't stick to it, you will not know how to improve it. If you're sticking to the trading plan 75% of the time, then any changes already have a 25% chance of not being accurate. Okay, so keep that in mind. It's like, for example, somebody says, what decision shall I make? But I'm going to give you 75% of the information. You've got a lower chance of being able to determine what trade changes need to be made. So the same applies with a trading plan. So the first thing, the basics of a trading plan. We need to know what assets we're going to trade. We need to know what hours are going to be traded. We need to know how we're going to determine the trade entry, how we're going to determine the trade exit. We need to know what tools we're going to be using, if any tools. We need to know the trade size. We need to know the trading methodology. We need to know what type of risk management strategies we're going to also have in place. We need a trade journal. And lastly, we need to know our daily routine. So here, ladies and gentlemen, we have 8 points. Now, we can make trading plans very, very difficult. And there's very advanced ways that I can, explain and look at a trading plan, but you will struggle to do it. Now, if we're going to limit it to the most important things, which are easy to use, then these 8 steps are the 8 steps that we need to look at. So a lot of people, they think, I need to trade and I need to scan through the whole of the market and see where there's opportunity. That's where a lot of mistakes are made. If you've got trader number 1 who's trading the Euro USD and he trades nothing else, that's the only thing he trades. And then you've got trader number 2 who trades 10 different assets, there's a higher possibility of trader 1 being a better trader. Why? Because his experience on that one asset alone is a lot more vast. It's a lot more vast, which is very, very important, because he's only trading that asset. His experience, his knowledge, he knows the domino effect of that asset. He knows the traditional price movement of the assets. He knows what's influencing the assets. He knows how it is being reacting to certain indicators. He knows everything about that asset. Whereas if you're trading 10 different assets, you know a little about a lot of assets. But it's better to know a lot about one asset. So that is one thing to take into consideration. The other thing to take into consideration is assets act differently in different sessions and during different hours. So for example, the stock market, if we're following traditional theories, which to be honest is one of the theories which are not necessarily just like a conspiracy theory, it's something that we see within the market. If we look at stocks in the US trading session, in the first hour, they act very differently to the last 2 hours. And there's very clear reasons why. And if we look at between the first hour and the last 2 hours, again, the stock market acts very differently. And there's a reason for it, and it's a valid reason. So we need to know also when to be trading. Another good reason is if we look at the past month, the Japanese yen, as it reacts in a certain way within the Asian session in the past month. As soon as we go to the European session, it completely changes. That may not be the case going forward, but if we look at the past month, that's something we've seen every single day. So we know what asset we're going to trade. We know we're going to be traded in these hours. Even if you're a scalper and say to yourself, I'm going to trade the British pound against Japanese yen and only trade it between 9 o'clock in the morning and 9:30 in the morning. It could be something which is very limited like that. It could be something which is not. It could be something like, for example, I'm going to trade the NASDAQ and I'm going to trade it between 6 o'clock all the way up to 10 o'clock at night. That's completely up to you. So everybody though should be making a note of this and be able to see exactly what things they need to take into consideration. We've got 2 people here actually saying, how can I get this document? To be honest, if there's something on your screen, just take a screenshot. I think that's the easiest thing because then you've got it straight away. But you will get the email sent to you tomorrow with the recording to the webinar. So you will have this anyway, just to answer the question. So the trading plan, asset. The first thing, bullet point, start with one asset. Start with one asset which is familiar to you. That's something which is extremely basic and something, even though it's so basic, people don't do it. When you go to university, do you study 1 degree or do you study 10 different degrees at the same time? Or for 1 month, you study 1 degree, the next month you study a different degree. Why you don't do it in your life, personal life, but you're doing it when you're trading. So again, can you see why exactly I'm saying to trade one asset? Because if you're trading one asset, especially if it's an asset which is familiar to you, it's like, for example, if you're, I spoke to a trader which was ecstatic about Apple. He loved Apple. And he said, I don't know what I'm going to trade though. And I said to him, why don't you trade Apple stocks? If you're not interested in Apple stocks, why don't you trade the NASDAQ, where Apple is the most influential stock? So trade something which is familiar. But if you're trading one asset, it's such a basic thing. But if you're trading one asset, your knowledge and experience and expertise in 6 months' time will be it will be significantly improved, significantly. But if you're not doing that, if every single day you're trading a different thing or you're trading 10 different assets, you are not going to be able to say that. Why? Because you're not familiar with any asset. You're just a little bit familiar with a lot of assets. And somebody says to me, a lot of people say to me, can I trade 2? I don't want to trade 1, I can trade 2. Look, it's down to you. I'm giving you the information, it's down to you. What I will say is it depends on your strategy. And what I also will say is a lot of people think the more I trade, the more assets that I trade, the more profit I'm going to make. No, if that's the reason why you want to trade the second one, don't do it, because you can trade one asset and make more than somebody that's trading 2, 3, and 4. So like, for example, professional traders, a lot of the time, they only trade one asset and they're more successful than most people within the market. So once you've chosen the asset, you want to check the asset's price movement. So go on a daily time frame, go on a 1 hour time frame, check all time frames, check every single time frame, ladies and gentlemen, and think to yourself, is this asset predictable? What type of price movements do we tend to see with this asset? Because if we're going to look at an asset and the price movement, ladies and gentlemen, it looks something like this. So you're seeing an upward trend, clear waves, and then you see a downward trend, again, clear waves. Okay, so you can see it's quite stable. The price movement is very clear and able to very clearly determine it. But if we're looking at something that goes up and then down, and then it goes up halfway, then down, slightly lower, then slightly higher, up here, and then down, and up, and down slightly lower, and so on and so forth. Of course, you can trade that. Maybe you're looking at a different strategy, such as the mean reversion strategy. But again, it depends on your strategy. Is it something you really want to look at? Why not look at something which is more stable, and you will be more easily able to predetermine how the market is going to move. So again, that's something you're going to take into consideration. Also think about, don't just say to yourself, I want to trade this asset, because if you want to trade, for example, let's say the NASDAQ, the NASDAQ is open in the US session. Well, it's actually open 24 hours a day, but most of the volatility and the nice price movements are happening in the US session. So if you're, let's say, for example, in the UK, just for an example, we may have people here from the UK, or if you're in in the UK office, because HFM has a UK office as well. If you are in the UK, you're going to be trading very, very late in the day. You're probably going to be trading at 7 o'clock at night. If you're a family man and you have children, most likely you don't want to be trading at 7 o'clock at night. So again, think about the asset you're going to trade and what session you're able to trade it. This is something you need to take into consideration when you're looking at what asset to trade. Then the next thing, which is the cheapest asset? A lot of people said to me, I want to trade this asset. For example, the Dow Jones, somebody said to me this morning. And I said to him, of course you can do that, but just so you know, actually no, it was the Nikkei 225, I think he said to me this morning, yes. And I said to him, just so you know, you can trade the Nikkei 225, but the NASDAQ, the S&P 500 is cheaper, just so you know. And he said to me, okay, maybe I'll trade the NASDAQ then. So you can trade any asset. And like I said, you're going to take different things into consideration. Like we can see here, what asset you're familiar with, what trading session you want to trade, which one has predictable price movements, and it's a price movement that you personally feel good about. That's something very important. It may sound stupid, but it's very, very important. But also take into consideration, what is the cheapest asset? So which one has the lowest spread? If you're trading with commission, of course, you may be on an account which doesn't have commission. Which one has the lowest commission? If you are a swing trader or looking to keep trades open overnight, also which one has the lowest swap fee? So for example, currency pairs, the cheapest is the Euro USD. Of course, this changes, but 99% of the time is the Euro USD. The one which had the lowest swaps was the British pound against the US dollar. The Japanese yen, which is very, very popular at the moment, extremely popular, especially over the past 2 months, and for good reason as well. Very beneficial, very nice price movement, probably maybe one of the easier assets to determine its price movement, but has extremely expensive overnight fees. So you need to take that into consideration as part of your trading plan. Don't keep the trade open overnight. So that's, again, you need to be aware of this. Somebody says here, how can I get access to this information? Somebody says, I apologize, you're seeing the wrong screen. I apologize. Now you should be seeing the right screen. So I apologize, guys. I was showing the wrong screen. So now you've got the right screen, ladies and gentlemen. So also keep that into consideration again. Indices with the lowest spread is the NASDAQ. The index with the lowest overnight fee is the S&P 500. So the USA 500. Metals, it is gold, of course. So that's just some useful information. The next thing, position size. Are you struggling to work out what the required margin is? A lot of people have said to me, I'm struggling to know, about the exposure of my account every time I'm opening a trade because I'm using MT5, not the HFM app. I don't know how much margin is required. People sometimes struggle with this, especially those which use leverage, and some people that don't want to use a very high leverage, so they require a higher amount of capital. I've got a very simple answer for you. a very simple answer for you, because I get a lot of people asking questions about margin, how much should I open, exposure. Very simple, guys. Open the lowest. You're very new traders. Maybe you've never traded before. Open the lowest trade size. I can tell you now, the people that want to become millionaires straight away, or the people that say come and start trading and say I want to earn 100% every single month, they're the ones that lose, because they're in a rush, they're overexposed, they're over risk, they become irresponsible in terms of trading. Open the smallest trade size. Then as your knowledge improves and your success rate is going to improve, you can increase it. Don't be in a rush. Don't be in a rush. Open the lowest trade size. The margin on gold, which is quite an expensive asset, by the way, when you open 0.01, it's only $2.65. Only $2.65. So open the smallest trade size. Even if you do understand margin and you're new to trading though, still take into consideration opening the smallest trade size, because you're going to open the smallest trade size, you're going to make some mistakes, you're going to need to change your trading plan, you're going to amend it and improve it, your knowledge will improve, and then when you get to a much better scenario, then you can increase it. Don't straight away increase it to one lot. After a month, increase it to 0.02 now that your success rate has increased. The next month after that, increase it to 0.03 and keep doing this, ladies and gentlemen. The idea is not for you to win the lottery, okay? Ideally, as traders, you want to be able to trade for 5 years, 10 years like myself, more than me, 15 years, 20 years. We've got people in the company that have been trading for many, many years. So that's something you want to do. Don't worry about this month. Worry about where you're going to be in 10 years' time. Okay, because if every 3 months you're increasing by 0.01, after 10 years you're going to be trading with one lot, but just in a much better position. So do not rush to earn or have successful passive income. As your success rate improves, you can increase your trade position slowly. Higher leverage is not the answer to everything, guys. Trade with the right leverage amount. A lot of people come and say the first thing I want to do is trade the highest leverage possible. There's benefits and disadvantages to high leverages. You need to understand this. Leverage can be a great tool. Yes, of course. It lowers the capital which is required, which is important a lot of the time. Depends on the trader. We've got a lot of high net worth traders I can see watching today's webinar. But for those smaller traders, it's very important. But there's disadvantages as well. So if the market moves against you, there's a lot of volatility against you. So trade with the right leverage amount. Also take that into consideration. The last thing I'll say is take into consideration the 1% rule. This is something which is very well known within the market, to use the 1% rule. So if you've got $500 in your account, you only will expose 1% of that to trades. So for example, that's 2 trades at a time for gold, because that's $5.30. So I've got $500 in my account. I will only open and keep open 2 trades in gold, and then I'll wait for those to hit their take profit before taking into consideration further trades. This is the 1% rule. So only have 1% exposed to the account. Take profit and stop loss. I've got some more questions. I'll look at these questions now. Somebody says, I need a different trading plan for gold compared to the British pound against the US dollar. Every asset has a different trading plan. It's a question. Look, strategies react differently to each asset. Each asset has different volatility levels, so the reward to risk ratio will need to change. Also, if you've got a different success rate on each asset, again, that's going to affect your trading strategy, the trading plan. I cannot say as a rule that each asset needs a different trading plan, because, for example, I see a lot of traders, because I also have some experienced traders request one-on-one sessions with me. And when I speak to those traders that I've been trading maybe 5, 6, 7 years, they may trade 2 assets, for example, because they want to trade all day. So they'll trade one asset in the morning because of that session and trade a different asset in the afternoon because of that separate session. Because they're experienced, regardless of each asset, their success rate is more or less the same. It's more or less the same. The volatility levels are quite similar as well. So his trading plan doesn't really need to change. But if it's a very different asset, the success rate is completely different, the volatility levels are completely different, you need to use a different strategy as well, then yes, of course, the trading plan does need to change. But I cannot say it's a concrete rule. I cannot say it's a concrete rule. So potentially yes, a lot of the time, most likely will be a yes, but I cannot say that's the scenario every single time. I've got another question. Does the trading plan depend on capital, or more important, is consistently or profitable plan then scale up for more capital? You do need to take into consideration capital as well. Yes, that's the answer. You definitely do need to take into consideration capital. At the end of the webinar, we're going to look at real trading plans. Simple, same scenario like we looked at on the first slide, but it will be completed. So everybody fully knows how to use it, and we're going to look at it live on the MT5. So to be honest, that probably will help answer your question as well. Somebody says, would you use the demo account for the assets to work the strategy? Yes, is the answer. But trading on a demo account, you may make different decisions to trading on a real account. The demo account is the exact same as the real account, but believe me, your decisions will be different because your emotions and the way you think about the trades will be very different when you start to go into a real account. So yes, but the demo account isn't the answer to everything. So let's continue, ladies and gentlemen. Stop loss and take profit. Very quickly, a take profit is basically a preset order that automatically closes the trade once it reaches a specified profit level, locking in the price. It also minimizes the risk as well. And I'll explain it in a very simple way. If you're looking at buying an asset, okay, let's say we're looking at Apple stocks. We mentioned Apple before, and the price does something like this, and I buy at this price here, which is $150 US. As soon as I buy, I put a take profit. So it's like a tool that says to the platform, if it reaches $200 US, I want you to automatically close that trade and put it into my account. So take that $150 that I invested, put it back into my account. The $50 that I've earned in profit, put that back in my account automatically as well. So if the price does go up like this, here the trade will close. So it's like I said, specified profit level. It locks in that $50 profit, and it minimizes risk because it could have hit it and then declined like that. So you avoided that decline, then you locked in that profit. So that's a take profit, ladies and gentlemen. There's a reason why we're speaking about take profits and stop loss and trailing stops, because we're going to use it as part of our trading plan. Now, a stop loss is the exact same. It's a predetermined level to close a trade, but when it reaches a specific loss. So you're basically saying, this is how much I'm willing to risk on this trade. So same scenario, I'm buying at 100, let's say I'm buying a cheaper stock, let's say Nvidia for $100 US. If it declines to 80 though, I want it to close. I don't want to risk anymore. I've lost 20, I understand that, but take my 80 and put it back into my bank account or trading account, should we say. So that's a stop loss. So stop loss, take profit. You're basically saying within the trading plan, that's how much I want to risk. That is what I'm trying to earn. That's going to become important because we're going to look at the 3 R's, the reward to risk ratio. I try and look at this almost on at least once a week, or at least once every 2 weeks, because it's so important. That is the difference a lot of the time from you being profitable and from you being not profitable. And just so you know, a very large percentage of traders that blow their account, they blow it not because of their success rate, not because of a lot of bad decisions, but a lot of the time it's because of 1 bad trade or 2 bad trades or 3 bad trades. It's not because of anything else. So reward to risk ratio is very important. The stop loss and take profit is pretty much saying that's how much I want to risk to earn that amount. Okay? It's like when you go to the casino. I don't like looking at it as betting because it's not betting. But when you go to the casino and you go to roulette and you put $10 on black, you know you're risking $10 to earn $20. So your reward to risk ratio is 2 to 1. You know, that's what I'm risking to earn that. But I don't like looking at gambling as a way of explaining it, but it's an easy way of understanding it. So manually exiting your trades can be more beneficial, but this depends on you, depends on how you're going to be trading, and it depends on your method. So for example, if you're saying to yourself, I'm going to trade for 2 hours a day, I'll trade between 2 o'clock and 4 o'clock, and I'm going to be sitting in front of my computer for those 2 hours, then there can be benefits to not using a stop loss and take profit. You're still saying to yourself in the market visually that this is my stop loss and this is my take profit, and you even put a line there on the price, but you're not putting a stop loss and take profit. Now, what's the benefit? Because if the price does something like this, and it just drops below your stop loss for 5 seconds, maybe 10 seconds, maybe 30 seconds, maybe a minute, and then it does that, you can see the benefit here. Yes, it hit my stop loss where I would have put a stop loss, but I didn't close it. I just looked at it. I knew if it was going to decline further, if it was going to gain momentum further, I would close it. I had my eye on it, but I said to myself, let's give it some more seconds. Let's give it a minute. Depends on your approach. Let's give it a minute. Let's give it 5 minutes. Let's give it 10 seconds. It depends if you're a scalper or if you're a session trader. Depends. But you can see that's a benefit there. If I wasn't doing it manually and that was my stop loss, it would have closed. I would have had a minus, and I'll be kicking myself in the foot because I would have hit my take profit after that. And that's not a great feeling. So if you are going to be sitting from the computer, then there's benefits to be looking at manual stop losses, take profits. So basically you're not actually using a TP or an SL. But if you're not going to be sitting in front of your computer, of course, stop loss, take profit, a great tool. It does have that disadvantage that sometimes volatility very quickly can knock it out. But you need to be cautious of that volatility. Some people say to me, why do we get that volatility? Because you need to think of the big boys within the market. Look at the big boys. Look at the hedge funds. For example, Vanguard. Look at these big companies, BlackRock. What they want to do is they want to buy at the lowest price possible, and for it, when they buy, to go up as strong and as quickly and as much as possible. To do that, they knock people out of the market. It's not illegal. It's not illegal. If they're doing it purposely, then yes, it is illegal, of course. But it's not illegal to say there's a lot of people selling here, so I'm going to go down to that price to take them out of the market. I'll buy it from them, and then the price goes straight back up. Whereas for us, who don't actually hold the assets itself, it creates that dip and that volatility. Somebody says, so can you use a bigger take profit and stop loss to avoid blowing your account? Yes, you can, of course, but as long as that is included in your trading plan. So we're going to move to your success rate, and we're going to move to your reward to risk ratio. As part of your trading plan, you've got the plan, okay? We're going to look at the plan. It's not on the next slide, but the slide after. When you look at your plan, you know the asset, you know the hours, you know how you're going to trade. This isn't a webinar about strategy, but you will know the strategy. At the end of the week, you know your success rate. You have to work out your success rate. Otherwise, don't even bother making a trading plan, because your success rate is extremely important, okay? And monitoring your success. Then the week after, you're going to look at the success rate again. So at the end of every single week, count how many trades you've opened and look at what your success rate is. It's very simple. If you open 10 trades this week in these 5 days, and 6 were you closed in a profit, closed, not currently in a profit. If it's currently in a profit, could move in the opposite direction. Concrete profits, concrete losses. 6 are in the closed in a profit, 4 in the closed in a loss. You have a 60% success rate. You need to do that every single week. It's a trade journal, extremely important. So you have to know your success rate, because if you know your success rate, you know what reward to risk ratio is required for you to be profitable. I said at the very beginning of the webinar, if you're beginners, yes, you most probably will have a low success rate. For every 10 trades you open, maybe only 3 will be in a profit. Maybe only 4 will be in a profit. Regardless of that, your trading plan should be set up for you still to be profiting at the end of each week. That's how it should be set up anyway. Whether that is the scenario, or whether you're keeping to the trading plan, or you're making of your success rate changes, that's a different scenario. So the first thing I would say with regards to your success rate, when you start trading and you're going to look at the reward to risk ratio, consider a higher reward to risk ratio, okay? A lot of the time people will look at a negative reward to risk ratio because they say, if I put the stop loss further away, there's a higher possibility of me hitting the take profits. Yes, that is possible. We need to double check that. I'll show you on the next slide how to double check that. Yes, that is possible, but that is only something which is responsible if you have a high success rate. There's no point you having a 30% success rate, but you're risking a lot per trade to earn a small amount. That makes no sense. If you've got a 90% success rate, then yes, makes 100% sense. That's absolutely fine. But if you're starting to trade now and you're a beginner, then of course you need to start somewhere. So start with a high reward to risk ratio. And then the week after, and the week after that, and the week after that, you can amend it. It could be 4 to 1, it could be 3 to 1, it could be 2 to 1. Depends on you, how high you want to go. After the first week of trading, you will know your success rate, but keep in mind the success rate will likely change within the first 3 months of trading. So every single week, your success rate may be different. That's 100% natural. What a lot of people do is they look at an average. So for example, let's say the first 4 weeks, week number 1, I had 30%, week number 2, I had 40%, week number 3, I had 50%, week number 4, I had 10%. It was a terrible week for me. That's normal for a beginner trader. Every single week he has different success rate, 100% normal. Look at the average, okay? So if we look, we've got 50, 130. So we've got 130, divide that by 4. Let's get a calculator out. Bear with me. I'll get a calculator out because my maths on the spot isn't good enough. So my success rate is 32. Okay, that is my success rate. That's the average success rate. And then what I'll do is I'll look at 75% of that, just to be safe. Just to be safe. So instead of looking at 32 points, or should we say 32, I'm going to look at 75% of that. So I'm going to divide it by 100, times it by 75. So even though sometimes I have a 50%, I have a 40%, I have a 30%, even though my success rate on average for these 4 weeks is 32, I will look at 24 or maybe 25. Why? Just to be safe. Better safe than sorry. So that's another thing for us to look at. So, example, trader A, he opens 11 trades per week. Always open the same trade size. Otherwise, your trading plan and the mathematics behind your trading is very difficult, and you end up will not do it. You will not do it. For example, I open different trade sizes, but I have a tool which will work it out for me automatically. It costs a lot of money. You're not going to be able to do it. You won't be able to do it manually. So best scenario, anyway, because you're beginner traders, 0.01 every single trade. The important thing is your knowledge improves, your success rate improves, and your reward to risk ratio improves. That is the most important thing. If you do those three things, then you're profitable. If you do those 3 things, you can increase the trade size. If you do that, happy days. So trader number 1, A, should we say, he's a beginner trader. He's a beginner. Doesn't open a lot of trades. He's not opening 11 trades a day. He opens 11 trades a week. He's got a low success rate, 40%. So basically, made a mistake there. That should be 7. So 40%. Apologies. So 40% success rate of 11. So that means either 4 or 5 trades a week will be profitable, because 40% of 11 is 4.5. So either be 4 trades or 5 trades which are profitable every single week. And then I've made a mistake here. Bear with me. So this, ladies and gentlemen, should be 6 or 7 losing trades. And we've got 4 or 5 profitable trades, okay? So 4 or 5 trades are profitable every single week. 6 or 7 trades are negative every single week. They're a losing trade. So his risk per trade is 6, okay? $6. That's what he's going to risk per trade. What he's going to look to earn per trade is $18. So very simple. He has a reward to risk ratio of 3:1. Every single trade he's going to open, his take profit. Let's look at a drawing. That's where he bought. His take profit is here at $18. His stop loss is here at $6. So he has a 3:1 reward to risk ratio. So that's something we need to keep in mind. So what does that mean, ladies and gentlemen? If he's got 4 or 5 trades in profit and he's got 6 or 7 trades in a loss, then on average 18 times that will give 72. 6 times that, the average, so 6 times 7 or 6 would be 42. So he's got a profit of 30 at the end of the week. So he's got a low success rate. Okay, every single week he opens 11 trades. 4 or 5 of those trades he closes in a profit. 6 or 7 of those trades every single week he closes in a loss. It doesn't matter though. We're thinking of it as a business. We got our revenue here, the 72, and we got our expenses here, which is the 42. So profitable trades, losing trades. At the end of the week, he's still profitable. Why? Because he's saying to himself, this is how many trades I'm opening. This is my success rate. How much do I need to earn compared to what I'm risking, regardless of the fact I've got a low success rate, to still be profitable at the end of the week? That's the scenario you want to be in. Let's look at another example as well. Sorry, we're going to look at this example and then we're going to look at more examples. So check the trades based on a reward to risk ratio. So this is something we're going to do. Let's say, for example, this is something we've set up, 11 trades, 40% success rate. This is where I'm going to put my stop loss. This is where I'm going to put my take profit. Then look at the trades again to see if you are able to change what you're looking to risk and what you're looking to earn. And you're going to check it against all of your trades. So for example, if you're selling here, so you're speculating decline at this blue line, okay? That's a great trade. People look at that and think, amazing. Look at this. Look at this downward price movement. Great. But you put your stop loss here. That is your stop loss. So you've entered the sell here. Your analysis was correct, was a great trade. Your timing was crap. So what actually happened was the price moved up and it closed on your stop loss. And then the market moved back in your favor and you're very, very unhappy. But if you move the stop loss here, so slightly higher, it wouldn't have closed. Now, if you've opened 11 trades this week like that, like I said, 6 of those trades were closed in a loss. If on those 6 trades, if you slightly increase your stop loss, how much will it improve your success rate? Will it take your success rate from 40% to 80%? Okay, that makes a lot of sense. If it makes no difference, of course, you're not going to improve. You're not going to take your stop loss further away. If it increases it only slightly to 45, 50, 55, again, is it worth putting it further away? Depends if you need to compare the new success rate based on that and the reward to risk ratio. Is it worth it? Because if it's not worth it, you're not going to do it. So you can see exactly how I'm looking to alter the trading plan. So that is a scenario here. Like I said, this is a scenario here where if I did move it up to here, the stop loss, it would have been a great decision, okay? Because it wouldn't have closed and then I'm in a lot of profit. But if I sold here, so that's my sell trade here. The price moved in my favor, amazing, amazing. I'm very happy, I'm very happy, I'm very happy. I closed the trade here. I'm still very happy, I made a lot of profit. That is a scenario where I couldn't increase it. I could not increase it. I may even say to myself, you know, I was lucky. Maybe I should take into consideration putting my take profit slightly closer, okay? Because I'm lucky there. That's just before the market changed. Maybe I won't make that decision, but for sure, if I put the stop loss further away, the take profit further away, it wouldn't have hit it. And not on this scenario, but maybe on another scenario, would have moved in the opposite direction and hit my stop loss, which is not what I want. The next thing I want to say before we start looking at examples of trading plans is to plan your trade and even the next trade after that. I've got a question here. Someone says, sometimes I feel like it's my account size which is the problem. What do you think is the minimum deposit to hold a trade for a day? I cannot answer that question. There's no yes or no answer. I need to look at the way you're trading and analyze it and evaluate it to be able to give you a real answer to that question. So it's very difficult for me to answer that. If you feel that the trade size, the account size compared to the trade size is the issue, lower the trade size. If you cannot lower the trade size, increase your account size if you feel that's the issue. But again, I would only do that if the success rate is in a good scenario, or if it's not, the reward to risk ratio is in a good scenario compared to the success rate. So if, for example, I'm opening 10 trades a week, my success rate isn't great, it's 30%, let's say, so 3 trades in a profit, 7 trades in a loss, but my reward to risk ratio is, should we say, very high, maybe 4 to 1, for example. So let's say, for example, I'm looking to earn 40 and I'm risking 10. So 10 over 7, yes, is $70. 3 over 40 is 120. So I'm still in a profit of 50. You know, my success rate isn't great, but the reward to risk ratio compared to the success rate is 100% fine. So if I've got that set up, then maybe I'm in a good scenario to improve my increase my account size. But if that's not the scenario, if whatever I do to the reward to risk ratio and whatever I do to my success rate, it's still not working and I'm still not profitable, there's no point increasing your account size. There's no point. You need to get it right and then increase your account size. So plan your trade and the next trade. So even before entering the trade, you should know where you're going to enter, where the take profit is going to be, where the stop loss is. Already know the alternative trade and the profit and stop loss. So what do I mean? Let's say the market is done this. Now I know here I want to wait for the retracement. The retracement happens. I'm still on the third low. I'm still on the higher high. So I'm still taking into consideration a buy. I know before the market even makes the move, I know here is where I'm going to open my buy. That's where I'm going to open my buy. Here is where I'm going to put my take profit. Here is where I'm going to put my stop loss. The price movement hasn't even happened yet. I'm just prepared and I've made that trade plan. So the price is still here. I'm not thinking about the trade as the trade happens. I'm thinking about it before it even gets there. These are my requirements. And I know that if it goes down to here, for example, I'm going to open a buy, for example, with a take profit here. That's my take profit and the stop loss here. Because maybe I've gone back to the support level. Maybe at that point, that's why I think it will be oversold. I don't know what. This is just an example. So I'm prepared before the price movement happens where I'm going to buy, where the take profit and where the stop loss is going to be. And if I get a bigger price movement against me, what is the alternative trade? It doesn't mean that the alternative trade again is going to be a buy. It may not be a buy. Maybe there it's going to be a sell. That's absolutely fine as well. I'm not saying it needs to be a buy again. Either way though, that is the alternative trade. So let's start looking at some examples. We've been talking now for an hour and 5 minutes, so I'm speaking for too long. So trading plan example 1. I'm going to trade the Euro USD. I want to do so because it has the lowest spread. I don't care about the swap. I'm not keeping it open overnight. I'm looking at ultra short-term trading, not scalping, but ultra short-term trading. I'm only going to be trading an hour and a half, so 10 to 11:30 in the morning, European session. So that's in line with Euro USD. Also, it's an area of the market where very rarely we get announcements. Maybe that's a reason why I'm doing it. The only time you get announcements in those hours is during the PMI data release, which we get the UK, we get Germany, we get France as well in those hours. Other than that, though, on every single day, we don't get much released in those hours. My account size is here. I'm going to open the lowest lot size. I'm using a leverage of 1 to 100. This is just an example. Yours can be completely different, but you can see what I'm looking at and taking into consideration. Somebody says, how many pips ups or down? Guys, you need to work out what the pip value is. It's very simple. Work out what the pip value is. Otherwise, you will not be able to have a trading plan. It's very, very, very simple. Work out what the pip value is. There's calculators on HFM's website. If you don't know how to use them, we've got the live chat and the support team. If you don't want to speak to them on live chat, you can give them a call. It's cheaper though to use the live chat. And they'll walk you through the process step by step. Alternatively, go to the HFM app and don't look at the pips, look at money. Pips isn't profit for you. Look at money. We're trying to earn money. So you need to look at money. How much money am I going to earn on this trade? How much money am I risking on this trade? I will not expose more than 2% of my overall account at a time. So basically that is $7. I won't expose more than $7 at a time. My success rate is 40%, and I've got 8 trades per week. My reward to risk ratio is 15 to 15 US dollars to 5 US dollars, so that's 3 to 1, and I'm not using a stop loss or take profit. So let's go to my calculator again. So I've got 8 trades divided by 100 times 40, so 30, so 3 basically. So every single week I have 3 trades in a profit, 5 trades in a loss. Okay. Per trade that's in a profit, we can see here is 15. So that is 45 US dollars, ladies and gentlemen. $5 is what I'm risking. 5 times 5, that is 25. It's very simple. At the end of the week, I'm in 20 US dollars profit. Why? Because I've got a trading plan. I've got a trading plan, and I know I've got a 40% success rate. Maybe I don't have a 40%. Maybe it's slightly higher. Maybe it's 50%. Maybe it's what I did before. And it's a very interesting and good thing to do. You look at the average of the past month, for example. If you're trading 2 weeks, use an average of 2 weeks. You're trading, 3 months, use the average of the 3 months. This is why it's important to have a trade journal. And maybe I've looked at the average and I'm looking at 75% of that, and that's 40%. That's absolutely fine as well. So here you can see exactly what I'm doing. It's 3 to 1 reward to risk ratio. So I'm going to share a different screen now, and we're going to look at that on the MT5. Let's look at that on the MT5. Let's go here. So US dollar against, excuse me, US dollar against the Swiss franc. This is something we had a trading signal on yesterday. We said the signal was with a bias of a buy. It has increased in value since then. So well done, guys, for everybody that was following that. But anyway, let's say we're above the trend line here. We're above the trading price sentiment level. We're higher than the neutral. We're at 60 on the RSI, and we can see the Bollinger Band's increasing. We can see we're on the upper side of the Bollinger Band. Let's say for whatever reason we're looking at those signals and we want to buy. Absolutely fine. You're more than welcome to do so. So what am I looking at, guys? Let's say I'm buying here. I've got a 3-to-1 reward to risk ratio. So let's say I'm buying here. Let's say, for example, I want to put my stop loss here. Okay, so just below, let's say I want to put my stop loss here, just below the low. And I'm going to measure that. So on the red line where I'm buying, that is, let's say, 0.22%. So if I've got a reward to risk ratio of 3-to-1, that 0.22% needs to be 0.66% above for the take profit. So I need to go even higher than that. 0.66. So that's where my take profit's going to be compared to my stop loss. Okay, based on a 3-to-1 reward to risk ratio. Let's say we also, by the way, you need to be cautious not to have different capitals on each trade. Each trade ideally will have the same capital. So don't, because you want to put a stop loss here, risk on this trade $60 and on the next trade risk $10. Makes no sense. The mathematics will not add up. So let's say, for example, to risk, you're risking at $15. Let's say $15 is here. You want 3 times that amount on the on the take profit. So the take profit is here, for example. This is just an example, but you can see here how exactly I'm doing it on the MT5. I'm doing exactly what I'm doing on my trading plan. Let's look at another example. This gentleman has a 55% success rate. Very different. He's also opening a lot more trades. So it's a very different scenario. We're still looking at one asset. This is the session. I'm trying to avoid the market open and too late in the session. So very clearly concentrated on specific characteristics. Trade size, lot size is slightly higher, leverage is the same, willing to expose slightly more than others. Sessions trading approach. So I'm trying to keep trades open for 1 hour, 3 hours, 4 hours. Could be less, but within that session. Success rate is 55%, 22 trades per week. So 12 trades are in a profit, 10 trades are in a loss every single week. That looks like a 6, it's a 0. So I'm looking to earn 20 per trade and I'm risking 11 per trade. So I've got slightly higher than the 2-to-1, slightly higher than the 2-to-1 reward to risk ratio. Apologies. Yeah, slightly higher than a 2-to-1 reward to risk ratio. So 20 times 12 is 240. So we can see we look at bigger figures here, guys, because he's got more experience, larger trade sizes, more trades. And then 11 over 10, that's 110. So his success rate, ladies and gentlemen, is 100. His profits 130 at the end of the week. 130 at the end of the week. What he's doing is he's saying to himself, what is the mathematics behind my trading plan? This is how much I trade every single week. Again, you should try and keep, if you're trading 20 this week, try and trade 20 next week. You know, the mathematics will start to get difficult. If 1 week you're trading 10, the next week you're trading 50, and then you're trading 20, then you're trading 70. Now, of course, every single week is different. Sometimes you may have 19 trades, not 20. Maybe you have 18, maybe you have 21, but you can see it's responsible and reasonable. But you're looking at the mathematics. You're saying, this is how many trades I'm opening. This is how much is going to be in a close or a profit based on my success rate. You may take into consideration a slightly lower success rate than you normally do, just to be safe. Depends on you. Some people don't want to do that, but that's absolutely fine as well. And then you really look at those trades and say to yourself, could I have put the stop loss slightly further away, and would that have improved this figure here, the 130 in a profit, and this figure here, the 55% success rate? Could I have put the take profit slightly closer or further away? And again, would that have improved the success rate on my profit? So again, this is also what we look at. So guys, that's the end of today's webinar. I'm going to release a poll. I'm very interested to see what your success rate is. So guys, let's vote, and I'll confirm what most people's success rate is. It'll be very, very interesting to see. By the way, I've got some questions. I will, of course, answer these questions, of course. Somebody said, I've got 2 people that say here. Let's see if there's any more. No, just 2 people. Okay, so somebody says if I can book a one-on-one session. Of course you can book a one-on-one session, of course. Speak to your account manager and he will book you in for a one-on-one session. Alternatively, go to live chats and tell them to book you in for a one-on-one session. And they'll more than happily book you in for a one-on-one session. So let's end the poll, ladies and gentlemen. 61% have voted. So let's end the poll and I will share it like I always do share it. So we have 54% with a 30% success rate. Why? Because most people are beginners watching today's webinar. So this is why on 2 of the examples, we said 30%. We'll look at an example again. 31% said 40%, so still low, but of course better. 8% said 50% success rate, so that's not bad. 4% said 60% success rate, so again that's not bad. And then we had 4% which had 70% success rate. This is probably one of the advanced traders watching today's webinar. So 70%, 80%, 90%, you know, those traders are deemed to be quite high. Like I said, regardless of whether you got 30% or 40%, let's take worst case scenario. If you're opening, let's say 15 trades per week, and you have a 30% success rate, okay? And I'll show you how we can do this, and we'll see how I can check in a scenario that won't work and a scenario that will work. So 15 divided by 100 times 30, just to see how many trades. So 4 trades every single week I'm a profit. 11 trades every single week I'm a loss. Actually, it's 5 trades and 10 trades. So ignore this. 5 trades in a profit, 10 trades in a loss. Now, if I'm going to have a high success rate, a high reward to risk ratio, so let's say 3 to 1 again. Let's say, for example, I'm going to look at let's say I'm going to look at a take profit of $10, and I'm going to look at so that's a take profit of $10. I'm going to look at a stop loss at $3.50. So small amounts. Of course, I've got $50 in a profit, okay, from those 5 trades, and 3.5 times 10. No. Anyways, 33 point times 3.5 times 35. There we go. So 50, okay, and then I've got here 35. Okay, so 10 times 3.5 dollars. So I'm in a profit of $15 every single week based on this 3-to-1 reward to risk ratio and these figures here. Okay, but if I had the same scenario, so 30% success rate, 15 trades, okay, and I had a reward to risk ratio of 2-to-1, for example. So let's say I was earning 10 per trade in a profit and 5 per trade in a loss. Okay, so that basically means, again, I had $50 in a profit from profitable trade, but then I had $50 in a loss from non-profitable trades, from the trades I closed in a loss. Here you can see I'll be at a minus. Oh, sorry, I'll be at a break even. But if my success rate drops to 29%, then I'm in a loss. So that is a scenario that doesn't work. So I know I need to amend it. I go back to my trade. Can I improve my success rate? Sorry, can I improve my take profit? If the market did something like this, and I bought here and the take profit was here, I could have put it slightly further away. So I'm not looking to earn 10, I'm looking to earn 13 compared to the 5 I'm risking, to make sure I've got that leeway there. So hopefully that's educational, guys. So you can see exactly how I'm comparing the take profit. Can I amend it? Can I amend the stop loss? And I'm looking at the mathematics behind my trades. How many trades am I opening? What my success rate is? What does that mean in terms of how many trades I will be profiting? How many will be in a loss? And what does that mean for my trades? How can I amend it? Yes, you will get a copy of the recording. Some guys said that the mathematics of trading is really helpful. I can't see any other questions. We've answered a lot of questions already. So let's end today's webinar, guys, because we've been speaking for an hour and 20 minutes already. So let's end it for today, guys. Enjoy the rest of your day. Trade safe, trade responsibly, and we'll see you in our next webinar. In the meantime, goodbye.